Hello and welcome. In the last few topics, we focused on the asset side of the balance sheet. Now, we're shifting to the other side to look at liabilities. A liability is a company's obligation to transfer an economic benefit, usually cash, in the future. We categorize liabilities into two main types: current liabilities, which are due within 1 year, and long-term liabilities, which are due in more than 1 year. Today, we're focusing on current liabilities. The most common current liability is accounts payable, which is money owed to suppliers. But one of the most significant for many companies is payroll liabilities. Have you ever looked at your paycheck and wondered why your take-home pay is so much less than your salary? That's because of withholdings. Your employer is required to withhold amounts for things like income taxes, Social Security and Medicare, and your contributions to health insurance or retirement plans. But that's only half the story. Your employer also has to pay additional costs on top of your salary. This chart shows the costs side by side. On the left are the employee costs that are withheld. On the right are the employer costs. Notice the employer has to match your Social Security and Medicare contributions and also pay for things like unemployment taxes. Let's see how this looks in the accounting records using an example from Hawaiian Travel Agency. First, the entry for the employee's salary. The company records the full salary's expense of $100,000 as a debit. The credits are not all to cash. The credits are to the various payable accounts for the amounts withheld, income tax payable, and FICA tax payable, and the final credit is to salaries payable for the employee's net take-home pay. Next, the company records its own additional payroll expenses. This entry debits payroll tax expense for the employer's share of FICA and unemployment taxes, and it credits the corresponding payable accounts. These are extra costs to the company above the $100,000 salary. Now let's look at a couple of other common current liabilities. First is deferred revenue. This occurs when a company collects cash before providing a service. Think of buying a plane ticket. You pay today, but United Airlines doesn't recognize that as revenue until they actually provide the transportation. Until you take the flight, that money is a liability on their books called deferred revenue. Finally, there's sales tax payable. When you buy something for $15 plus tax, the company collects the full amount but doesn't get to keep the tax portion. They are simply collecting it on behalf of the government. As you can see in the entry, they record the sales revenue, and the tax collected is recorded separately as sales tax payable, which they will remit to the state later. It's a liability for them, not an expense.